Hello, and welcome to another edition of LPL Market Signals. My name is Lawrence Gillum, fixed income strategist here on the LPL Research team, and I am joined with our chief market strategist, Quincy Crosby. How are you today, Quincy?
I'm fine. Thanks for inviting me to join you. I appreciate it.
No problem at all. I couldn't think of a better person to discuss what's going on in the markets right now. We have a very busy week as it relates to central banks. 11 central banks meet this week, starting today, in fact, where we had our first surprise. We'll talk through that. But other central banks meeting this week, we have the Federal Reserve, of course, the Bank of England, the Bank of Japan, which may turn out to be an interesting meeting. So we'll talk through all that.
Yeah.
Certainly want to talk about and get your perspective on equities. Equities have really moved lower since last week's higher than expected inflationary print. So certainly want to get your perspective on markets and kind of what you're looking for and expect the rest of the year on markets. And then finally, we'll talk about interest rates. You know, how much higher can rates go? We've seen a big move higher in Treasury yields this year. So maybe we've seen the most of that move higher, but frankly, we'll get into how much higher we think interest rates can go from this point. But for sure, it's all about central banks this week. 11 banks meet this week. An expected 500 basis points of rate hikes are priced into markets. It looks like it's going to be higher than that, given the surprise that we saw today with the with the first bank, or the first central bank meeting. The Swedish bank raised rates by 100 basis points today instead of the expected 75 basis points. So right out the gate, we're already getting higher than market expectations in terms of interest rates. So busy week for central banks. Quincy, kind of what are other, not talking about the Fed just yet, we'll get into the Fed a lot more in just a second, but what are some of the other meetings that you're paying close attention to this week?
Well, I'm actually paying very close attention to Japan because the rates have been incredibly low. The dollar, Japanese yen differential, just bizarre. And the question is, are they going to intervene? That's the big question right now. Are we going to see an intervention from the Bank of Japan? So we'll see how it unfolds vis-a-vis their bank meeting, but also in the currency. It's going to be, it's important. We forget Japan is the third largest economy. And also, Japan is the largest foreign holder of U.S. Treasuries. Remember, folks, they move back and forth with China, who displaced them as the largest foreign holder of Treasuries and also buyer of Treasuries. But now Japan has got that first place role again. So it plays an important role even in our economy because, and I mentioned this, Lawrence, is whether or not the Japanese are going to pick up the pace of buying. We've talked about this before because the more we have buyers come in, it helps bring down the Treasury yields, doesn't it? It makes it more attractive. And we know that they have not been buying at the rate they've been, and a lot of it has to do with the currency differential. So this is going to be an interesting day or an interesting week because of Japan.
No, great points there, Quincy. And what's interesting too with the Bank of Japan, they've been one of the outliers. They haven't been hiking rates like these other central banks have, but their inflationary print last night came in about 3%. So now there's more discussion or more chatter out there is that maybe the Bank of Japan has to be a bit more hawkish than they've been in the past, which I never thought that would be the case in my lifetime. So we'll see if they actually do it. But these inflationary pressures are global in nature, as we know. And maybe they're leaking into the Bank of Japan's mindset as well. So we'll have to see if they're able to actually raise interest rates like these other central banks. But I think your point about the FX transmission is an important one. As we know, as the Fed raises rates here, that impacts currencies globally, and that impacts our trading partners and emerging market debt countries and their ability to service their debt. Outstanding debt payments. So, there's a lot going on, these second and third order impacts of just interest rate hikes that are going to flow out into the real economy, especially as the pace of rate hikes continues to be higher than, frankly, we've seen in quite some time. So the other important bank, aside from the Fed, Bank of England, they're set to meet this week. The expectation is 50 basis points. Their economy's not doing great though. So, I mean, I think the harder they push on interest rates, we may see a slowdown in the Bank of England or even in the Eurozone, more broadly. So they're in a very difficult situation right now.
Exactly, they are. But then again, you also have a push on the fiscal side, which of course is the government side, right? Monetary side is central bank, fiscal side is the government side. And we may actually see the proposals coming out of the new government with Liz Truss, who is the new head of the government. She comes from the Conservative Party. She replaces Boris Johnson. But she has a number of initiatives that she wants to get through, which may, help the economy, but in addition, it could also help feed inflation. This is the difficulty that we have around the world. If you help on the fiscal side, the policy side, it may just then induce more inflation. But if you're a politician, you're not going to worry about that. You want to have a better approval rating when all is said and done.
Yeah, no, that's great points. I mean, one of the main responsibilities of a politician is to get reelected, and the easiest way to do that is to provide fiscal stimulus, which at this point in time in these global economies is only going to add to the inflationary pressures that we're seeing, making central banks' job a lot more difficult. So fantastic point there.
Tug of war.
It is absolutely it's a great analogy. So turning our attention to the main central bank meeting this week, and that's the Federal Reserve. Market expectations are for 75 basis points on Wednesday. Terminal Fed funds around 4.5%. But what else are you looking for out of the meeting tomorrow, Quincy?
Well, above all else, I'm watching this statement, but also the press conference. And the reason I'm doing that is that the market is, and I have to point out the initial knee-jerk reaction to the statement. And then as the press conference begins, comes from algorithms. And the algorithms pick up certain words, they pick up certain sentences, and they move accordingly. They're in a nanosecond. Then, of course, that's followed by traders. But the point is that they're looking for anything that is either more hawkish than what he said in Jackson Hole, Wyoming. I don't know how you can be more hawkish, but if you are, it's going to pick it up. And I think it's going to push the dollar even higher. It will push rates higher and the equities go down. Conversely, the market also seems to, Lawrence, I don't know if you agree with me, but I've been following when the market shifts and starts gaining. For example, just to give you an example, when he was up on Capitol Hill, I think I still call it the Humphrey Hawkins meetings, but they do an assessment of the economy. But he made a comment and he added this. He said, we are looking at economic data points. Remember, he added that, and the market took that as, oh, so that does matter. So raising rates, it does matter what happens to the economy. And suddenly we had the market climb higher. Now, again, I think it was the algorithms picked it up, but the market also picked that up. It shifted the mindset of how dangerous the Fed could be. Also, when he speaks at the press conference, I think the Fed knows this. They know exactly the words that he says and the reaction in the market. But if it has even a softish tilt to it, you could see the equity market rise and you could see probably the yields pull back. And I think, this is what the market is looking for. Obviously, the reporters, Lawrence, are going to ask him those questions. At what point do you see the economy hurting, where you can't fix it, where there's momentum on the downside? Someone's going to ask a question along those lines. And we need to see how he answers it. But, I don't know. I do know he's mentioned Paul Volcker a number of times. And I saw that the Wall Street Journal picked it up, his inner Volcker, which is very hawkish, needless to say. And then also, I do want to mention this, and then that's it. But they mentioned that the Fed now is focused on one of its mandates, and that is price stability. This is important because I think most folks don't realize our Fed is unique. It has two mandates. One is to create an environment of sustainable economic growth, which is the labor mandate, and the other one is price stability. Other central banks, it is only about price stability. Now, here's the interesting point. Have they given up on the other mandate, the labor market? No, because one of the things he says over and over again is you cannot have a healthy labor market ultimately unless you have price stability. You cannot have a healthy economy unless you have price stability. And I think he may be forced to say that yet again when folks say, well, there are analysts who think you're going to push the unemployment rate above 5%, above 6% if you keep going at this rate. He may have to repeat that line simply because the European Central Bank, Lawrence, if you remember, I think it was 2008 or 2009 as the world was realizing, realizing that portfolios were filled with subprime mortgages. You had Jean-Claude Trichet raised interest rates. Do you remember that?
Yeah, for sure.
Remember that? And he was blamed, like, how could you do it? Well, because they have a mandate above 2% inflation, you raise rates. In fact, you don't have an option. It is built in. That's the way it is. When it moves that way, you don't discuss it, you just do it.
Yeah, no, great points and great, points broadly. It's amazing to me though, how granular people try to kind of, parse his words and comments and all this and that. Reminds me of I'm going to age myself here, but reminds me of those days back with Greenspan, and they had the briefcase. And how thick is the briefcase, and is it any indicator at all? Markets, frankly, especially right now, are really living and breathing and dying by what the Fed is saying, and it even isn't saying. So there's going to be a lot of focus on that on tomorrow's meeting. What's also coming out tomorrow is 4 times a year they update their economic projections. They're called SEPs, or Summary of Economic Projections, where they forecast economic growth, inflation, the labor market. Now in June, you could make the argument that maybe things were painted a little bit too rosy, a picture for kind of what they're expecting to do on the rate hike side. Maybe it wasn't really filtering through on their expectations for labor market and growth and inflation, et cetera. So we might see a revised summary of economic projections, making kind of economic growth a little lower, labor market unemployment rate a little bit higher, and inflation maybe a little bit more stickier. So these are all things that could potentially move the market tomorrow.
Well, yeah, absolutely. But I do have to say, I don't know anyone who takes those reports, those projections seriously, because even in the short term, they have to be revised. What about when they're looking out many years? I mean, it never holds up. I mean, you can't blame them because you mentioned Alan Greenspan he said, I can't even project what's going to happen over the next 6 months.
Yeah, for sure. The other thing that I think maybe people take a little bit too seriously is the dot plots. We're going to get a revised dot plot, and a dot plot is just the individual participants where they think the Fed fund rate is going to be at the end of this year, next year, and then longer term. So there is it looks like a Jackson Pollock painting with just little dots everywhere. But it is going to show presumably a higher median terminal rate relative to June. Markets expect a terminal rate in that 4 to 4.5% range. So maybe we get something that could be a surprise there. But to your point, I think a lot of folks pay way too much attention to that as well. So that's something that markets will be watching for, with that release as well tomorrow.
Lawrence, do you remember? I think a couple of press conferences ago, when they had this a while ago, he even poo-pooed the dot plots. You remember that? Do you remember? Powell himself did.
Yep. Yeah, I do. And I remember he's been saying this, to take these dot plots with a grain of sand, and it's, but folks don't, because it's being released by the Fed. And like we just talked about, they're going to parse everything and anything that comes out of the Fed for any sort of, maybe some secret message. We need our decoder rings on there to see what they're actually really meaning when they say this or what have you. But unfortunately, markets do pay attention to that in the short term. So again, that's probably going to add to some volatility to the equity markets. Anything else on central bank week before we get into the equity markets?
Well, yeah, I do want to mention this, is that the market tends to do statistically extremely well right after the press conference. It usually that day or that afternoon, the market I want to say, is it 100%? But certainly be at least 90% of the time, it does extremely well. Maybe it's because Powell specifically has a softer tone when he's speaking, and especially answering questions. And that the market picks up rays of hope that maybe they'll be finished earlier than the market is projecting. So the market tends to do well on press conference days.
Yeah, good. Yeah, good point. That hit rate is pretty high, and I think the Fed has a pretty. First of all, they have a pretty impossible task balancing their two mandates. But I think Jerome Powell does a pretty good job of communicating the Fed's intentions, and to your point, maybe that does come off as maybe a bit more dovish than what the statements and the other releases may imply. But yeah, he does have a way of calming people's nerves after these releases and during these press conferences. So,
well, Lawrence, I have a question for you. What do you think? Yeah, no, what do you think? I mean, given that the Riksbank, the Swedish central bank, came in with 1%, we've had the Bank of Canada, not the last meeting, but the meeting before, 1%. What do you think with the folks who are saying that the Fed could actually do that? So in other words, really front load, get it done now while the labor market is still intact, and come in with 1%. And here's the question for you. Given that Powell said, look, we're going to be data dependent, that maybe the Fed feels that they did not have to telegraph to the market that they were shifting from 75 basis points, 0.75% to 1%. And then just does that. I'm just asking, what do you think?
It's an interesting point. What's really interesting is that previously the Fed has kind of really followed the data and been data dependent. It seems like the Fed is really following kind of market expectations. So I think if markets were saying that there was a greater than 50-50 probability of a 100 basis point rate hike, they would do it. But now markets are kind of back in this 75 basis point rate hike. So I think that they're really paying attention to what market expectations are. So it's certainly a possibility, especially after what we saw today out of Sweden. But I still do lean towards 75 basis points as the rate hike. And remember, what was it, a couple of meetings ago? Not everyone agreed with a 75 basis point rate hike, right? I think it was Loretta Mester from I forget where she was from, but she dissented on this, given the fact that these rate hikes they take a while to flow into the real economy, and maybe that being overly aggressive right now, sure, it might help anchor inflation expectations, but does that dig us into a deeper hole, a deeper recession down the line when these interest rates do eventually make their way through the economy? So I do think it's on the table. I think it'll be discussed tomorrow, but I think we still lean towards 75 basis points. So with that, let's turn our attention to equity markets. It's been in a drawdown here recently, still above the June lows, but kind of what are you looking at? What are you thinking about when you look at equities right now?
Well, it was interesting is that the sell-offs that we've had came just a tad above 3,900 on the S&P 500, right? I mean, you'd have a really nasty sell-off and somehow it was just above 3,900. And of course, we broke it on Friday. You could argue that the market was paying attention to the rate, Treasury yields climbing higher, because we saw that on Friday. We saw the 2-year push higher, didn't necessarily stick, but today it is. We saw the 10-year push higher. But we also had the remarks from the FedEx. Now, granted, there are many analysts who suggest, look, much of that had to do with specific FedEx issues, but they still are seen as a bellwether. And when you had a comment that it looked as if we were headed to a global downturn, the selling picked up. So the question is, of course, do we break the lows that we had? And it's very possible, especially if we see more revisions, negative revisions, early negative revisions. Similarly, if we can have some positive comments and guidance before we really get into the earnings season, it would be helpful to anchor, I think, expectations on where what companies are looking at. But I think it would not surprise anyone if the market, especially today, by the way, if he is a bit more negative, if he is seen as more hawkish, and then, it's not enough to have him speak. So if he is a little bit softish, what does the parade of Fed speakers then do when they start coming out with the same message? You know how they try to switch it and say, "Oh no, this is really what he meant," kind of, that could push the market lower. And again, we have to keep our eye on the yields. You talk about this, Lawrence, is the inverted yield curve getting steeper across the curve. I took a look at the 3 months and 10-year today. It's getting very flat. It's getting flatter. And folks, the 3 month to the 10-year, according to the San Francisco Fed, is the one that has the edge on looking at impending or recessions. Correct?
Yep, that is correct.
And
And we're going to talk about that in just a second. Yep.
Oh, I'm sorry.
No. It could. I mean, it's a great point, because yields and we try to glean these market signals from various markets, and right now that inverted yield curve is telling us something that maybe we should be paying attention to with these rate hikes. So, and that certainly is going to impact equity. So, no, we're going to talk about that, but that's a fantastic point, Quincy.
Well, thank you, Lawrence. I learn everything from you, of course. But people always ask, why? What's so special about the 3 month? And the way that I explain it is, it's closer to the real economy. It's closer to what companies, how they see borrowing, how they see the environment, the economic environment, more so than say the 2-year to the 10-year. Similarly, if you look at the 2-year, that one is closer to Fed policy, right? Look at where that is today, the 2-year, and then it filters down to the 3-year, the 3 month rather, and that is one. Again, why did the San Francisco Fed close in on that and do the research on that? Because it's closer to the real economy. It's closer to how companies see the environment, how they view banks, lending, and ultimately default rates and so on. So it's getting awfully close this morning.
Yep, for sure. And again, we'll touch upon that in just a second. One last question on the equities and your outlook for equities. We're still a ways away from the unofficial kickoff to earnings season. I think that's still a couple weeks away. Correct me if I'm wrong there, but in the interim, it's going to be largely macro driven, and really markets are going to be focused on Fed and inflation and economic data, and maybe not have the same support from earnings if they are a lot more positive than markets are expecting.
Well, we do have earnings. I mean, I call it the official, unofficial. It starts with the banks, right? But we'll hear from Costco. We're going to hear from a number of the housing, the builders are reporting. So we will get it, but we're also looking at revisions. And that's extremely important, because you don't want to see a spate of negative revisions, because what companies will do, the way FedEx did, is come out early and say, look, we're changing our view. But they also, if we have positive surprises, it would be very helpful before we get into the actual, what is it? I think it's October 14th when we start that week that starts the banks.
Yep. Yeah. The FedEx pre-announcement was a game changer for markets, and we certainly saw equities lower the next day. So, kind of changing our attention to Treasury yields, as you mentioned, Quincy, we have seen a big move higher in Treasury yields. This is the 10-year Treasury yield right now. We've seen about a 200 basis point or a 2% increase in the Treasury yield this year. About 100 basis points or a 1% move higher in Treasury yields last year. So this 300 basis points move higher in Treasury yields since we bottomed back in August of 2020. It's the biggest move higher in yields since 1987. So we have seen a significant move higher, and it's all because of these changing Fed rate hike expectations. So
yes,
the higher the inflation data comes in, the I guess the more frequently it surprises to the upside. We can continue to get higher yields in the Treasury market. But to your point, this inverted yield curve is something that we're paying a lot of attention to. This is the difference between 2-year Treasury yields and 10-year Treasury yields, or 3-month Treasury yields and 10-year Treasury yields. They are an important kind of market signal that we are paying attention to, listening to. And as the Fed continues to push rates higher, the front end of the yield curve continues to move higher at a faster pace than the intermediate or long end part of the Treasury curve. So we are getting this inversion. And again, to your point, these inverted yield curves have presaged, every recession over the past, I think it's 30 years or so. But certainly more or different tenors are more important than others. The 3-month tenure, as you pointed out, is the one that has the stronger academic backing from the San Francisco Fed. It's not inverted yet, but it's getting pretty close. So that's something that maybe it's flashing a little warning signal that maybe the economy is about to enter into a recession. It's not our base case this year for a recession. We're about a coin flip that we'll see a recession sometime in 2023. But we are paying attention to these market signals, and right now these Treasury yields are kind of flashing yellow, if not red, currently. So something that we are paying attention to. The other chart I wanted to show and certainly get your impressions on is this is the Fed's balance sheet, right?
Mm-hmm.
Quantitative tightening. This is going to be the wild card, I think, for markets over 2023. So the Fed has a nearly $9 trillion balance sheet made up of Treasury securities and mortgage-backed securities. It's about 40% of GDP currently. They want to bring that back to 20% of GDP. So they want to remove a sizable amount of Treasury securities and mortgage securities off their balance sheet. So this has only happened one other time, and it didn't really end well. This happened back in 2018, 2019, and they're only able to remove about $750 billion from their balance sheet. Now they want to take trillions off their balance sheet in a market, a Treasury market anyway, that's pretty illiquid currently. And there's a lot, the economic data is weakening. And I mean, I think this is going to be a monumental challenge for the Fed to actually get their balance sheet down to closer to 20% of GDP. But how do you see this playing out?
Well, I go back to a comment when Janet Yellen was going to launch quantitative tightening, remember? And what did she say? She described it to the market as, don't worry about it. It'll be like paint drying.
Like watching paint dry, that's right.
Like watching paint dry. And it wasn't like that. I remember the repo market. And you have to believe, though, that the Fed is sensitive to that. They went through that. What was it? Drying up of liquidity, the overnight market, and they do work with banks. But as you've said so often, Lawrence, the liquidity in the Treasury market is not what it was, and it's much more difficult. And I think by implication, you meant it's not what it should be. Am I right? You need more liquidity in that, especially during a period of quantitative tightening, of draining the balance sheet.
Yeah, for sure. And as the Fed steps away from some of these Treasury markets, mortgage markets, one of the responsibilities of the Fed is to make sure that these markets are fully functioning. And if the Fed, as one of the largest buyers of Treasury securities over the past few years, if they start to reduce their footprint and we start to see the Treasury market say malfunction a little bit and freeze up like we saw right before the COVID shutdowns, I think that the Fed is going to be stuck in these markets for longer than they want to be. So something again to pay attention to. There was a research paper out of the Atlanta Fed recently talking about the impact of balance sheet reduction on financial conditions. Again, it's not widely known, so they have to do the research, and they think that reducing their balance sheet by about $2.2 trillion over the next 3 years will add about 25 to 75 basis points of rate hikes in terms of tightening financial conditions. So, even with the Fed and there are other economic folks over there, they don't really have a great understanding of how this is going to play out. So it is something that we're going to watch and markets are going to be watching. I think it's going to be a big story for 2023. So with that, we'll kind of talk about the week ahead. It's not all about the central banks. Certainly the central banks will be getting the most attention this week. There is also a lot of housing data that's coming out this week. And as we know, the housing market is starting to show signs of slowing down a little bit. Anything else that you're paying attention to this week, Quincy?
No, I'm actually just watching really the rates. I think the rates are going to be guiding the equity market. And we'll see, look, when all is said and done, we are still going to have an oversold market. We're going to have an overbought market. We're going to have to go through that process where buyers come in. But I'm paying very close attention to any guidance we have from the companies that are actually reporting this week. They're on a different calendar. Not every company is on the quarterly calendar. So I'm going to pay attention to that and just pay attention to the to yields. I think the story for the equity market is going to come out of the credit markets.
So as a fixed income person, we're not used to being the center of the universe. We like to stay in the background and eat lunch by ourselves. But right now we are the center of the universe. And it's I think until the Fed starts to slow their rate increases and yields start to, level out at certain levels, I think that's going to, until that happens, the equity markets are still going to, experience a lot of volatility as well. So with that, we will wrap it up. Quincy, thank you so much for joining today. Fantastic insights as always, Neil, our fantastic producer, best in the world as far as I'm concerned. Thanks, Neil, for putting this together and making it ready for public consumption. And then, of course, thanks for listening to all the listeners out there. We will be back next week, same time, same place. Until then, hope everyone has a great week. Take care, everyone.